Hi everyone. Global inflation remains one of the most influential forces shaping financial market in 2025. After 2 years of persistent price pressures, major economics are finally showing early sign of stabilization, but the path ahead remains uncertain. According to the International Monetary Fund (IMF), global inflation is expected to average 4.8% in 2025, down from the 6.4% in 2024. However, this apparent improvement hides deep regional differences. Advanced economics, including the United States and the Eurozone, and moving closer to their 2% targets, while emerging markets continue to face elevated price pressures due to currency depreciations and higher import costs. Recent data from the US Bureau of Lahore Statistics shows consumer prices rising at an annual rate of 3.2%, slightly higher than expected. Energy prices have been volatile, driven by fluctuations in crude oil and gas markets. Food prices, meanwhile, remain sticky due to ongoing supply chain disruption and climate-related challenges affecting global structure. Research from Oxford Economics highlights that monetary tightening cycles over the past 2 years are finally starting to slow inflation, but at the cost of weaker global growth. Central bank, including the Federal Reserve's European Central Bank and the Bank of England, and signaled potential rate cut in early 2026 to support recovery. However, economists warn that cutting rates too soon could reignite inflationary pressures if energy or commodity prices spike again. In developing economies, inflation remains a serious challenge. Countries in South Asia, Africa, and Latin America have struggled with double-digit price increases, largely due to exchange rate instability dependence on imported energy. According to World Bank data, the average inflation rate across low-income nations stand near 9.7% compared to 3.5% in advanced economies. From an investment perspective, the shift in inflation expectations has significantly affected asset allocation strategy. Gold has remained strong as investor hedges against future inflation uncertainty. Cryptocurrencies, particularly bitcoins, are being viewed as alternative stores of value, though with higher volatility. Equity markets have remained resilient, but valuations and becoming stretched, with suggesting possible correction if inflation persists. Bond yield has stabilized after a turbulent 2024. Investors anticipate central bank easing. Academic research from the University of Chicago Booth School of Business finds that inflation uncertainty tend to increase equity risk premium, meaning investors demand higher returns to hold riskier assets. This also implies high volatility and shorter investment horizons. Meanwhile, the real economy is showing mixed signs. Wage growth in the US and Europe remains strong, but productivity gains have slowed. Many economists worrying that wage inflation could become sticky, preventing a rapid return to 2% targets. At the same time, automation and artificial intelligence adoption are helping some industries offset labor costs, but not enough to fully neutralize global inflationary momentums. Another factor driving inflation trend in geopolitical fragmentation, trade barriers, inaction, and supply chain realignment, particularly between the West, China, and Russia, have reshaped global manufacturing patterns. The World Trade Organization (WTO) recently reported that cross-border goods trade declined by 2.1% year over year, reflecting both protectionism and localized production shift. In some day, inflation in 2025 is neither a past problem nor a runaway threat. It's evolving into a structural challenge that will continue to shape central policy, markets behavior, and investment strategy for traders. This means watching not price data but also microeconomic triggers like wage growth, commodity cycle, and geopolitical shifts. Thanks for watching. If you find this deep dive analysis informative, make sure to like, share, and subscribe for more research based update on global economics and market.